This week's episode is brought to you by Capital Financial Advisory Group for all your retirement needs.
Broadcasting from coast to coast, it's the Financial Safari with your host, Coach Pete D'Arruda. You'll hear from some of the nation's top financial professionals. So stick around and find out how to make it through the jungle of the financial world, right here on the Financial Safari.
Welcome to Financial Safari. We talk retirement here. I'm consumer advocate Dave Perkins. Gregg Berrian is Coach Pete's local trusted advisor. Gregg, we talk retirement, and you really give us what we need to consider in all the facets and components of retirement planning. But let's mention one thing. You have really, in a very concise way, loaded a lot of critical information about Medicare in one website, one platform.
It's basically, we are launching this week something called 30-Minute Medicare, of which people have the opportunity to be able to reach out to myself or my staff. I've got a staff that I've trained on my own, okay, and answering any questions that they have about Medicare. So it's going to be out there in a funnel. You know, you'll see it in Facebook, Google, and whatnot. But you can actually access it through the QR code that we have. Also, actually, Pepe can probably put the QR code on here right now for us. And also, it's going to be accessed through through text code 600-700.
Okay. All right. Easy enough.
Yeah, easy enough. Or also give us a call too. I think you have the phone number there, don't you, Dave?
We've got it. Just call the number on your screen and we'll give you the information you need, and that is the numbers 30minute-medicare.com. So that's exciting.
You know what I found though, Dave, is we meet people all the time here, okay, for all different reasons, mostly for, retirement planning. And sometimes people think they have a really, really good grasp on what they have. And, and that's our job, is to unpack everything and dig down, look and see. But rarely, how about never?
Okay. Never.
Does a person come up to me getting ready to enter Medicare saying, I know what I need to know. Because what it truly is they're like a deer in the headlights. People will admit they know virtually nothing about what they're going into.
It's a lot.
And they require help. And so what happens? They get sent books this thick. And they get inundated with telephone calls, and it's just ridiculous. Next thing you know, they look at this book, their eyes roll to the back of their head, and they go, "Okay, ignorance is bliss."
Right.
With us, and like the whole video is only 24 minutes.
That's amazing.
That's it.
And I like the way you simplify it, because it's important to you for people to understand, the ones you work with.
Yeah.
It's their retirement.
Yeah, it is. It's a critical, important part. It's kind of funny. I was talking to my wife today on the phone, and she was trying to tell me about it. I went, okay. Whatever you say, baby.
Whatever you say. And that's just one component. We've talked about how retirement is different today. We've got a couple of stats here. More than 4.1 million Americans will reach age 65 through 2027. It's about 11,000 a day hitting retirement age.
That's crazy.
It's a tidal wave.
That's like a small town every day.
It really is.
And the thing is actually this year, 2024, is the reason I went forward with this, because I just saw this tsunami of, we call them T65s, coming our way. And so this year, more people turned 65 than any time in history.
Yeah.
And it's going to continue on for the next couple of years as well, because the boomers, it's a pretty strong, it's solid. It's big.
Well, it really is. And of course, things have changed. Private sector pensions have pretty much gone away. So I know that's where you come in, and the team, and building in that personal pension. Let's look at some strategies. First off, diversification. What's good diversification?
It's kind of funny. People say, well, I have multiple mutual funds. Okay? And when you open them up, when you look inside the mutual funds, you're going to find that very often some of these mutual funds, they're all invested in the same thing.
The same thing, overlap.
You have overlap all throughout them. And it's not only what's in those mutual funds and things like that, but it's the kind of money that you have.
Okay.
For instance, if you're sitting, let's say you're sitting on $1 million and you have $950,000 in the stock market, you're a little over your skis.
Oh, yeah.
Okay, you're out there, all righty? Now, if you have $10 million, you're not over your skis. Because if you lose 30%, yeah, you lose $33 million, but most people can live on $7 million. It's that $1 million and under where it'll really, really hurt, that if you were to lose money and if you need that money, all of a sudden something called sequence of returns kicks in. So therefore, what we really require is a strategy that allows you to enjoy the gains of the stock market, but not the losses. So you basically get the best of both worlds. And you have to have that one component, call that our green bucket money.
Okay, that's the green bucket.
The green bucket money. You need that green bucket, Dave, in order to make sure that you can make your bills. You can take care of what we refer to as your income gap. And that income gap, it's like one thing leads to another. You know?
Right.
And that income gap is like, let's say you have $4,000 coming in Social Security between you and your spouse, and you need $6,000 a month. That income gap is $2,000. So therefore, that's a $24,000 income gap. That's a significant amount of money annually. So you really need to have at least $500,000 of that $1 million in an account that is going to actually produce for you and be able to take care of all your bills.
And the benefit is you can count on it. You can count on it. It's there.
Absolutely. Guaranteed for the rest of your life.
The financial fill-up, as Coach Pete calls it.
The rest of your life. No matter what happens in the market, you'll have income coming into you for the rest of your life.
All right, that's nice. And then what factors inflation?
The red bucket really is the inflation fighting component. It's also, not only is that inflation fighting component, it's also the bucket that we use. Like, let's say the market went down, but you want to buy that new boat. You don't need that new boat. That's discretionary spending. Okay. So then you wait for that market to come back, and that's when you utilize that. So we also refer to it as play money. That's your play money. Green bucket is your pay money.
And then you've got an emergency fund of some sort.
You got to have at least 3 to 6 months of what you spend in an emergency fund, basically bank, money market. I mean, golly, there's some money markets out there like over 4%, and you can access it right away. So you want 3 to 6 months in those positions.
Okay, and that way, I mean, then you see the confidence building when they see these strategies come together.
Oh yeah, it's like all of a sudden it's like you can see this breath of fresh air come to them. It's like 1 million pounds is just lifted off their shoulders.
You know, and also, too, you and the team keep up with any changes out of Washington, for instance, Secure Act 1 and 2.0.
And there are probably 3, 4, 5, 6.0.
Could be.
Yeah. I mean, right now, we're looking at some major changes in Medicare. Real quick, one of them is going to be, this is a good change, in which halfway through the year, they're going to call you up to make sure you're taking advantage of the benefits you have coming to you. Because a lot of people leave benefits on the table. And the other one could be a little dicey. This could be a little dicey. For some people, it's going to be great. For some people, it's not going to be so good. And the people it's going to be great for are people who have a high dollar costs on their medications. They're going to put a cap of $2,000 in 2025 on the cost of your medications. So somebody's got to pay for that, Dave.
Right.
And so like I said, some people will be happy. It's kind of like what happened with the Affordable Health Care Act. It was great for folks who didn't have it, but also it tripled insurance rates.
Yeah, you have to anticipate. They have to keep up with things. There are also opportunities out of legislative changes to take advantage of. Also, call the number on your screen and schedule and claim for yourself a comprehensive review with the team at Capital Financial. More Financial Safari coming up.
Memories with Grandpa.
My first job.
My fourth job.
Crazy road trips.
Our first date. Meeting our son.
Exploring our world.
Our world. Family and friends. Our special song.
Secure your retirement by meeting with a financial advisor.
So, you've taken a good hard look at your retirement portfolio and you realize you need help. You've watched some wonderfully produced videos by a financial advisory group. And now you have decided to meet with an advisor. But there's a pretty important question that remains. How do these folks get paid? In the next few minutes, we will clear up this confusing topic for you. Writer Thomas Carlyle said, "A fair day's wage for a fair day's work. It is as just a demand as governed men ever made of governing." A financial advisor's job is to make sure that your money is secure and growing throughout your retirement years. But in terms of their money, advisors are typically compensated by commissions, fees, or a mixture of both.
Advisors are all paid differently, and it all depends on the company they work for. If you have an independent advisor, there can be multiple ways they're paid depending on what they're doing for you, and it could be depending on what they're doing for you at the time. So I always say disclosure is key. But commissions are when an advisor is paid to put you in something, whether it comes out of your pocket or the other companies. So the definition of commission is a third party paying the advisor on behalf of you.
You can tell you're with a commission-only advisor when they're constantly trying to sell you something. And really, the correct financial strategies and products should be bought, not sold. In other words, you should be searching for them, not somebody searching for you to sell them to you. Very important, because there's a lot of strategies out there that don't make sense that people have in their portfolio.
So the question you should be asking is, what should I be looking for when it comes to advisors that make a commission?
So the advisor who's 100% commission is always trying to sell you something, and a telltale sign is you look on your statement, you'll see parentheses around money, and that means that's a negative, but they don't want to put the negative sign. A true negative on your policy should be, if they want to put parentheses, that's fine. They should put a negative sign in front of it. It should be in red. Red means loss. Red means risk many times. And if you say, well, gosh, my advisor said I'm not taking much risk. If your advisor is taking commissions out of your plan, you might as well be in a lot of risk, because it's the equivalent of you being in the wrong place. Let's say you buy a stock at 100 and it turns into 90. Well, you lost 10. If an advisor's taking out commissions, you lost money too. So I always say, whose retirement are you funding? Yours or your broker's? And if you have commissions coming out of your plan, you're funding your broker's retirement.
Maybe a strategy that pays an advisor a commission is better for your retirement plan. The important thing is to be aware of how to identify when an advisor gets paid that commission. But that's not the only way an advisor gets paid.
A fee-only advisor will charge you a fee to put a plan together. Now, hopefully the plan will be good, because if they're charging a fee, it better be a good plan. But many times we see them also try to make money after they charge you the fee. So if you are with a fee-only planner, and they're bragging about being a fee-only planner, get them to put in writing they're not going to make any kind of compensation anywhere else off of you, and make them sign it. Guarantee they probably won't, because there's a lot of hidden games and gimmicks. They'll design a plan, they'll charge you for a plan many times, and then inside the plan is a lot of commission-driven products they're recommending, or products they're getting kickbacks from. So be very careful on that. Make sure if they really are bragging about being a fee-only advisor, the only fee you should pay is for the plan. And I'd argue the plan's not worth it anyway, because we put plans together similar or better, in my opinion, and we don't charge a penny for them.
So there are advisors that make commissions and fee-only advisors. But I've heard some financial folks say they are fee-based. What's the difference?
Fee-based looks at your assets. They're supposedly managing your money. They've got money managed platforms. Hopefully they're doing it themselves if they're charging you a lot of money. But that means they charge you a percentage of fees, a percent every single quarter of, depending on what you have under management with them. And it could be 1 or 2% per year divided on a quarterly basis. They're taking money out of your money.
There is a subclassification called gains-based. That's a gains-based system, or some people call it a spread, which means that the advisor, or hedge funds are big pieces of this, is where they take a cut of the profit. Now, that doesn't mean you make 100 grand, they get 1% of it. It's a fee-based system, but only on gains. So if your portfolio is positive 10% for the year, it'd be just like you brought home 9%. Just like if you paid a fee-based 1% advisory fee. But when the account's down or doesn't make money, there's no charge. So it's more of a skin in the game approach, but not a lot of advisors utilize it.
Between commissions, fees, and gains, it can seem you have a lot of money coming out of your retirement plan rather than staying in. Do you really need to work with an advisor in the first place?
Not a day passes when I read articles or hear people talking about, is my financial planner really worth it? Why am I paying the person? Well, if you could do better on your own, maybe you should. If you could compare your performance to an index fund, let's say a Vanguard low-cost index fund, and you're not outperforming that and you're paying an advisor, you're in the wrong place. Many people that are watching this probably would be better in an index fund with, on one side, for the risk, with a growth protection income account on the other, making sure they have a pension plan that will give them income, but then not paying a lot of fees on the other side. Fees are financial termites. Commissions are financial termites. Risk, inflation, taxation, all financial termites. The reason why you're paying an advisor, if you are paying one or working with one, is they need to reduce or eliminate financial termites.
So there it is, the financial advisor demystified. Any financial advisor worth their salt will disclose to you exactly how they are getting paid, and now you can know whether they're doing what's right for you. Maybe you've taken a look at your retirement plan and need a second opinion, or you find yourself in the unfortunate situation where your retirement planner is funding their retirement instead of yours. Come meet with Coach Pete and the Certified Fiduciary Planning Team at Capital Financial. Take advantage of our no-cost, no-obligation financial review to understand the ins and outs of your retirement plan, including where all of your fees and commissions are going. Contact us today. Also, be sure to like this video and subscribe to this channel for more retirement help.
I'll tell you where it really comes from. It comes from two different things. One is misconceptions, and number two is there's too many annuities out there, and there are different ones with different purposes. There is one annuity that's made a lot of people mad over the years called a variable annuity.
That's the one I've heard about. Yeah.
And you know why they call it variable? Because the money can go up and down. All right, a fixed annuity gives you a fixed set of interest for a fixed period of time. So let's say a CD at a bank, when it comes to mind of that. So let's say you get a 5% interest for 5 years. That's a fixed term annuity. So you know exactly what the interest rate is going to be there term. Fixed indexed annuity lets you share in the gains of the market, but never in the losses of the market. Pretty good deal, isn't it? Now, you're not going to get all the gain. That's the rules going forward. But that's a great rule because that enables you to advance your money and protect your money. Advance your money and protect your money. And that's with the income that you can never outlive too attached to it. So if you basically have your own personal pension that does not have risk attached to it. Sort of like a 401k with no chance of a downside. Yeah. But, of course, you're not going to get as much. Like when the market's going like crazy, you're not going to get the gigantic returns, but you're not going to get gigantic or minimal losses. You're not going to lose a thing. Makes a lot of sense to me. Go to annuityavenue.com for bunches of videos explaining all the ins and outs of every annuity out there. Annuityavenue.com.
Talking about the last time we did a show together, the Visionary Engines, and I checked it out at PeteOnDemand.com. I mean, you've got everything from the future benefits predictor to the 401k power illustrator. It's a lot there.
Yeah, Visionary Engines. In other words, you can hypothetically put different numbers in to see what really could happen. You envision things happening. So it's sort of like the old financial calculators, but these are financial calculators on steroids. Yeah. You can go to visionaryengines.com or PeteOnDemand.com to get a look at that yourself. It's no cost or obligation for these calculators and visionary engines, and it really does put you in control. It's good to see, Dave. I mean, if you do certain things, what could happen, right?
Muni bonds are bonds that are purchased through municipalities, so they're normally smaller, like states, counties, such, but they generate tax-free income, whether it's state and federal, just state-free. A lot of people like it because of the tax-free source. Okay. Well, with the rates being low and then finally increasing, they're becoming more popular. Yeah. And that's a big thing about them is they can be a reliable source of income. But it depends on the goals and objectives of what it is. They're still only generating percentiles that are normally under 5%, but the tax-free benefits is huge. So a lot of people forget, you put money in a CD, you put in after-tax money in a CD. When that CD matures and you take that money out, you have to report the federal tax on that interest. So if you're getting 5%, you're really only getting closer to 3%.
Okay, sure, yeah.
And then, but on a muni bond, if you can find one paying 5% and you get that tax-free 5%, that's all in your pocket. Okay. So that's where it can be a great source. But the big thing is here is it's a good source for certain goals and objectives. Normally only after-tax money. They're not great in retirement accounts because there's no benefit of the tax efficiency in a tax-deferred or tax-free Roth. But for cash, it can be a great alternative to I-bonds, high-yield savings, but it's used for more of like an extra emergency account. But when you're getting to strategies where you have a big excess, like over a year in cash reserves, I mean, we can run a lot of plans here that can beat those rates, provide tax sheltered strategies or other guarantees or components or growth options that they can't do in bonds. So it depends on the goals and objectives. So it's very case by case.
Welcome back to Financial Safari. Consumer Advocate Dave Perkins along with Coach Pete's local trusted advisor, Gregg Berrian. Retirement, that's the focus. That's what we talk about here. And you share something with us, a case study, if you will, a hypothetical, but you call it strategy du jour. Because of your French blood.
Yeah.
Right?
Yeah, my French blood.
But it's very relatable. You know, people can put themselves in these studies. So we have a 68-year-old woman.
Yes.
She very correctly is concerned about making sure she has guaranteed income for life.
For the rest of her life.
How do you make it happen?
Oh, man, I'll tell you something. This is green bucket.
Okay.
Not a huge amount, $250,000, okay? But what this is going to do for her, now, with guaranteed income, the older you are when you turn it on, the better it is. You know, some folks that are in their 50s, I don't recommend a guaranteed income turning it on because what they're going to get is a little lower. Because the older you are, the higher the percentage of what you have in there comes to you. Mm-hmm. Okay. Not only is it good because of this person's age, it's also good because it'll go up every year if the market goes up.
Okay.
So it has an inflation fighting component inside of there. So let's say, okay, class, here we go, right here. So this person is 68 years old, moving $250,000 in there, and we can turn income on day one.
Day one.
Immediately.
That's what she wants.
Here's what I love about this, Dave. At 68 years old, this person's going to get 6.45% of that $250,000. Okay. Mm-hmm. Now, we've been doing this a long time, you and I. We've been talking back and forth. What is the suggested amount that they say you should be taking out of your accounts?
Well, the 4% rule.
The 4%. So this is basically 6.45. Yeah. It's like 30-40% more.
With a little bit of more confidence in it, right?
Well, and it's locked in. Yeah. So not only is this guaranteed, so this particular case, they're going to start off with $16,125.
Okay, nice.
A year. All right, I mean, if this was like in a different type of strategy, a different type of, you know, in the red bucket, we're looking at $10,000. Okay, 4%.
Yeah.
And they wouldn't want to go any further. And then you have the risk of losing your money. And so here's what's neat about this. This particular case, now let's say this person was married. We can attach the spouse to that as well. Okay. So let's say this person who had this was single when they died. Anything left would also go to the beneficiaries. And let's say they're married and they died. Let's say they died 3 years into it. Then let's say the spouse lived another 20 years. That spouse would get that money.
They get it.
Until that spouse passed away.
Wow.
But if all goes according to plan, okay, let's say, you know, the market goes up the next year, this person's going to get $16,609. The year after that, $17,107, then $17,620. At one point in time, it'll get up to $22,990. Now, don't forget, we start out with $250,000.
Right.
All right, and you're getting almost 9%.
Wow.
Almost 9% on this, Dave. That's really insane. And here's the beautiful thing. Okay, at that point in time, this person ran out of money.
Okay.
There's no more money left in the account. I mean, the cupboards are bare, okay? Right. But it's kind of. I'm gonna do a little Bible study. It's like, you know, this. You know, when Jesus took the loaves of fish and the fish and the loaves of bread, okay? Yeah. And it just wouldn't go away. Alrighty.
That's actually a good example of this.
It's a great example, and so that's what's going to happen. So if this person lives, let's say, to 100 years, I don't even know if I go up to 100, 95 years old. Alrighty. They would have taken out $596,000 out of $250, and they always had that money coming to them. It's a pretty beautiful thing. Yeah.
Yeah, that actually, the biblical analogy was pretty good, Greg. Yeah. It was very good. Yeah. And she was happy, right?
Yeah. This hypothetical person, you know, Mathemax, whatever it is, you know, they're just delighted. They see that and they go, that's crazy. That's awesome.
I mean, these are real strategies.
This is real.
Yeah.
This is real as this computer on my desk.
Well, let's look at when you are looking for someone to help guide you into retirement, as we do at Capital Financial. What are some good questions in that first meeting? Greg's put together some, and we'll throw them to Greg. Here's one, and don't be hesitant to ask these either. How do you get paid?
None of your business.
I knew that was coming.
Yeah. No. What I do You never pay me. I'm always paid by the companies that I work with, and I get paid once, unless it's Medicare.
Okay.
Okay.
All right. There you go. I love the transparency.
And actually, as a matter of fact, by law, we have a commission disclosure statement that everybody gets and signs off on.
Okay.
And nobody cares.
Right. Right. I mean, I think people understand you being compensated. They just
make a
want
living.
Transparency in the process.
Yeah.
This is one. I just want to make sure we can get this in. Explain to me your investment strategy.
Well, we kind of like touched down on in the previous segment. What we do is primarily we work with the rule of 100, which a lot of people work with that rule of 100. Those big box retailers, what do they utilize? They utilize the bond market for that safe money component. But you ask anybody who is in the bond market, in the past couple of years, when the interest rates went up, they lost money on their bonds. So what we do is we have a combination of that safe money piece, that green bucket money, which we talked about, with the $250,000 getting $16,000 to start, and also that red bucket money. What's kind of cool is when you have that safety, when you have that net below you, okay? And if you're walking that tightrope, I'd imagine when you're walking a tightrope and you got a rope, you got a net below you, you're walking a little more confident. You got a little more moxie.
A little less scared.
Than if you're like walking across Niagara Falls without a rope. Like that guy did. That was crazy.
Yeah, exactly. And that's
a scary proposition.
Yeah, that's a great risk example. You want to make sure that you've got everything. Diversification in assets, but also in strategies?
Yeah, well, absolutely. And so therefore on the strategies, you don't want overlapping on that as well.
Yeah.
And so you want that differences, which is you take your age, 65 years old, say, and you want to have 65% of your assets in that green bucket. Okay. And you want that 35%, let it rip, let it go.
Yeah.
We tend to go a little more aggressive on that 35% that's left behind. Why? Because we can.
Because you can. Yeah, very good. Good questions to ask. And here is another one. I'm going to actually put a little twist on this.
Alrighty.
The question is, how will you communicate with me? But let me add on to that a little bit. How often will you communicate with me? What can I expect with reviews going forward?
Well, first of all, we will communicate as often as necessary.
Okay.
Okay, as often as necessary. Second of all, I expect minimal us talking either face-to-face or via Zoom or a phone call at least once a year, minimum once a year. Because every year we have to look at the strategies to say, okay, what's working, what could work better, is there something new that we need to look at? And so, life changes and we need to change with it.
Absolutely. Bring your questions to Gregg. They're important. He'll have questions for you too, to better understand you, your unique financial situation. So if you do go forward with Gregg and the team, it's a custom approach. Call the number on your screen to get that process started. Also, the website, 30minute.medicare.com. Really compact, concise explanation of Medicare prepared by Gregg Berrian. 30minute.medicare.com. Thanks so much for joining us on Financial Safari.